All right, so good morning, everybody. We met last week and we have had some discussion about the cross rate, which is a very important component when you are studying the mechanism of exchange rates. I want to revise it very quickly so that you can see how the working mechanism of cross rates once again. And here you can see that I have some hypothetical example. And just in case it happened that I find that the £1 is equal to 1.25 euros, and I wrote the exam in the parentheses that this is the prevailing rate, not hypothetical, but let's assume that it's actually in the market. And then you also find one more rate, which is €1 is equal to 1.50 American dollars. And this is, let's imagine that this is also you see in Yahoo Finance or any Bloomberg or any other web page. Then based on this, you can make a third rate, which would be, say, €1 is equal to, if I divide 1.50, how much would I get if I divide 1.50 by 1.25? I have to check my mathematics. It should be 1.50, 36.5, 1.20. Yeah, exactly. So it should be $1.20. And where does it come from? Because 1.50 divided by 1.25 is 1.20. But actually, this is not the real rate. This is a cross rate, cross exchange rate. Cross exchange rate, you can also call it equilibrium. Equilibrium, theoretical, or notional exchange rate. So many names for this. So, yeah. But let's imagine that you check Bloomberg or Yahoo Finance, you find that in reality, €1 is selling for dollars 1.25. Let's say this is the real rate. How do you interpret it? Well, the one way of making interpretation is that the price of €1 in American dollars should be 1.20. So should be is 1.20. The price actually is 1.25. It means that pound is overvalued. Okay, so pound is more expensive than what it should be. The price of pound should be the price of, sorry, my apologies. So the price of €1 should be this, but the price of €1 is this. It means euro is selling more expensive. The euro's price should be this in American dollars, but the euro is selling for this much price, 1.25. Okay, so it means that euro is overvalued. Euro is overvalued against the dollar, or I can also say that dollar is undervalued against euro. Okay, and if you are a speculator, you have two approach to deal with. You may think that this 1.25 is overvaluation. The price should be 1.20. And before the price drops to 1.25, sell your euros as soon as possible. So that, because if you sell in the market, it's giving you 1.25, whereas the price should be 1.20. So if you sell €1 now, you are getting 5 cents extra by selling, 5 American cents extra. Okay, the other approach can be that, hey, if you have the euros, don't sell them now, because it could be possible that the gap between the real and the equilibrium exchange rate becomes even wider in the future. So the speculators or the people who deal in the financial markets, they have different way of thinking. Okay, so you can say this way, that the price should be this, the actual price is this, hence the euro is overvalued. Okay, so if a currency is overvalued when its actual exchange rate against some currency or currencies is higher than the cross rates. So this is one way of justifying the importance of cross rates in the financial markets. Okay. If you have any doubt or any question, you can ask me now about the mechanism of the cross rates. If not, then we move on to the next point. So I need to have a new share the slides. And we continue the next point which we are going to discuss today is the exchange rate equilibrium. The exchange rate equilibrium is basically based on the price mechanism or the market mechanism. Before I discuss these exchange rate equilibrium, I want to take you to a bit in the history, bit in the background when you were not in the university and you were studying in a school, maybe in high school, and perhaps at that time you were studying economics. If you were studying economics some 3, 4, 5 years ago, then it could be possible that you have seen a picture like this. Please tell me if you haven't seen such picture before. Text box. So let's call it price in euros. Price in euros. And then here we write down with the text box demand and supply. And this can be called as a demand curve. So I can call it demand curve. Demand curve. And this could be called as what is that? Yeah, supply curve. Supply curve. And then in the middle, there is when they meet. We call it a point of equilibrium. equilibrium. Okay, and this equilibrium shows that they both are equal. How many of you have seen this kind of picture in your life? Or I should say that who has not seen this picture ever? Hmm? Yeah, this is the equilibrium price. So this is the demand curve. And as you see that the demand curve is inversely related. Yeah, I think we all have seen it. Okay, good. So you can see that there is an inverse relationship between price and demand. So as the price goes up, the demand goes down. And as the price goes down, the demand goes up. It's very logical. If the price of something is expensive, you buy less of it. And if the price of something is going down, then you buy more of it. Okay, but when you talk about price and demand, you think from the consumer's point of view, the buyer's point of view, not consumer, but the buyer's point of view. But when you see the supply curve, you see from the seller's point of view, the factory's point of view, the business person's point of view. And here you can see that when the price is increasing, you supply more because then it's more profitable. And if the price is low, you supply less because it's not profitable to sell. And when the both demand and supply meet at one point, that is called equilibrium. And by the way, this picture is the simplest, simplest and oral expression of what is free market or what is the price mechanism or market mechanism, or even capitalism, or even capitalism, yeah, or even capitalism. If somebody asks you, can you explain capitalism, but without explaining, which means that you have to tell somebody that what is capitalism, but you don't have to say anything. You don't have to use any expression. Without orally, you have to say, then just draw this picture. This is capitalism. Because every decision is taken by the demand curve and supply curves interactions. And when they become equal, then that price exists and that quantity is supplied and demanded in the market. And if there is any problem, if, for example, price for some reason goes up than what it should be, then supply is more. As you can see, supply is bigger, but the demand is less. Supply starts from here to here, but demand is this much. And if supply of something is more than the demand, then what happens to the price? Normally we see that if something is too much in supply, but the demand is not that much, then the price starts dropping. So in other words, the price will start dropping. On the contrary, if the price is, for some reasons, not this one, if for some reasons the price is below than the equilibrium, then you can see that the demand is this much and supply is this much. So demand is more than supply, and when something is demanded more, than what is available, then what happens to the price? Well, then the price goes up. So any disturbance, any deviation from the equilibrium price would bring it automatically back. And this is why we call it capitalism. We call it free market economy, because all the decisions are taken by the demand curve and supply curve, and no decision is imposed by any government or any state or any authority or any lobby or like that. So these decisions are freely taken by the people. It's very democratic in many ways. The same thing, the same argument apply when we talk about the exchange rate. So if in this picture, I replace, if I replace the exchange rate, so maybe I can draw a new picture. So, or I can show you what we have already. So remember this picture in your mind, keep in your memory. And now I'm going to take you back to the slides. Here, it looks similar to what I drew. Well, I drew the straight line, but it doesn't matter. Here is the exchange rate. And let's say here is the exchange rate of £1. And the demand for pound is downward sloping, like demand for anything is downward sloping. And why it's downward sloping? Because we know that if for example, exchange rate, we are living in Eurozone, and in case the pound becomes very expensive, for example, let's say now pound is equal to 1.3 euros. Let's say pound becomes 1.7 euros. Then what happened? Then the price of everything you buy from Britain, the imported goods, will be up. And when the price is up, demand is less. In other words, you will demand less products from Britain. And as a result, because you don't need any, you don't want to buy goods from Britain, then why would you buy the pounds? So it means when the pound value against euro, I hope you can see the cursor movement on the screen. So in case the pound's value, the pound's exchange rate against euro is very high, then the demand for pounds would be low. But when the pound becomes cheaper, very low price against euro, then you find the British made goods cheaper. You find, okay, let's buy this thing from Britain because it's much cheaper there. On the contrary, it means that the demand for foreign exchange, which in this case, the foreign currency in this case is pound, the demand for pound is downward sloping, like demand curve we just saw on the, when I drew that picture, the demand curve, the relationship between the price and demand is downwards. And here price is the exchange rate. So exchange rate basically is the price of pound in euros. So basically exchange rate is also the price. So one way of defining the exchange rate is that exchange rate is the price of 1 unit of a foreign currency expressed in terms of number of units of the local / domestic currency. On the contrary, now see, this you think from the point of view if you are planning to buy something from Britain. But what about if you are an exporter? You are selling goods to Britain. And if the exchange rate is very high, it's good for you, because you are still selling the same amount of goods to Britain, but for every £1 you get from Britain, you get more euros back home. So it's good for you. And same way, if the pound is very low valued, then you as an exporter would not like to sell goods to the UK, because when they still give you £1, they don't know. People they were paying you they were buying your goods for £1, even now they buy for £1 in their local market. But when you convert those pounds to the euros, you get less amount of euros. So you don't have any incentive to export. So therefore, the supply curve is also showing the same phenomenon. So the supply curve of pound is just like supply curve of potatoes, chocolates, wine, anything. So it's not different. And once they meet, once they meet here, this is called, what is the point it's called? What was the word I used in that whiteboard? Anybody is aware of it? Do you remember? What word I used when they meet, the demand curve and supply curve?
Equilibrium.
Equilibrium. Very good. Very good. It's equilibrium. And here is the equilibrium. And let's say the equilibrium is a pound is equal to 1.60 euros. And this is determined, this is not decided by any government. This is decided by the market, the buyers and sellers, the importers and exporters. Okay, and this is the market decision. And in case, you never know, there's some deviation and the exchange rate is 1.80 here, so it must be here. And if the exchange rate is 1.80, the demand would be less, but supply would be more. It means the demand for pounds will go down, as you can see at 1.80. I'm not writing it here, but you can see that it must be above 1.60. So if the price of the exchange rate is a pound is equal to euro 1.80, then the demand for pound is less here, but supply of pound can be more. And if pound are more in supply, less in demand, then the value of pound in euros will go down automatically. On the contrary, if the pound is selling for 1.40 below, then the demand would be this much on the blue line, and the supply would be this much on the red line. And demand is more, supply is less. And as a result, in other words, it means that the pounds available in Belgium are few, but the pounds demanded in Belgium are more. And as a result, the price of pounds in terms of euro will go up, and it will keep going up till the demand and supply curve meet each other once again. So this is called self-adjusting equilibrium, self-adjusting mechanism, because it adjusts itself. And this is why if you have seen or read some economics course before, the classical economists call it invisible hand. That if there is any disturbance, then this disturbance is automatically taken care by, or this disturbance is removed by the equilibrium, by the invisible hand. And what is the invisible hand? This is the market. This is the market. And what is the market? Market is an interaction of demand and supply, simple. So this is how the exchange rate is determined in the market on daily basis. So basically, if I take you back to a website, once again, we go to Yahoo Finance. So if I Yahoo Finance, so if I share my screen with you now, so we are in Yahoo Finance now, and if we have the currencies, for example, let's say if we have euro vis-a-vis dollars, American dollar. So you can see that today, so the price has been this much. So you can see that today, euros value has been going pretty much up. So, it's fluctuating, but the value, this is the American quote, so you can see that it's changing constantly. So this is, I want to ask you a question. The demand curve and supply curve. Do you see the demand curve and supply curve here in this picture, in this green picture? Do you see it somewhere? Can you visualize that the demand curve and supply curve is here somewhere? There's a one answer. Let's not go into bid and ask, but my point is that in this picture, just focus on this green picture. Do you see a demand curve and supply curve here somewhere? Yes or no? Okay, no problem. There's one response. No. Okay. All right. Remember the shape of this graph, how it looks like, and I'm going to take back you to the whiteboard. Remember that the shape is something like this. So, okay. So I take you back to the whiteboard, and I open a new slide. If I So there is something, there was a y-axis and then there was x-axis. And now I need to draw something. Does it make sense? Every point here is a demand curve and supply curve. Here, there is a demand curve and there is a supply curve. Every point, there are countless points. Each point is basically showing the demand curve and supply curve. About 6 a.m., the price of euro was low. It means that during that time, the demand fell and supply also fell. But around 7 a.m., I'm talking about American time. Remember that American markets just closed. No, they're about to, oh, sorry, the Japanese markets, okay. So basically every point here, wherever you see the line, that line is representing the demand curve and supply curve. It's not visible. The tip, look at this point, is the peak. Here again, the demand was very high and supply was matching it. So that's why, because the demand was very high, the price was up, people were selling euros more at that time, and they were getting more American dollars. So supply was also matching. So every point on the graph is representing that the peak, the tipping point, the peak, the highest point is, there is an invisible demand curve and supply curve lying there. So basically, when you see this picture once again, what you saw here. So you can see that every point, there is a demand curve and supply curve. Now about 7 afterwards, okay, whatever is the time, let's go. So there are so many phases where the price of euro was going up. Actually, the price of euro constantly showing up. I think today is a good day for euro. So people who are selling to America and they are getting dollars would be richer today. But those who are buying goods from America and they are making payments in American dollars, they would be having a bad time today. So it means that the demand and supply um, they are interacting. So I can draw from here to here, I can draw countless demand curves and supply curves. But basically, all these decisions, why this price is going up? Because it's decided by the market mechanism, the demand curve and supply curve. There's more demand, less supply, price goes up. Price falls, less demand, more supply, simple. So you can see that this is a very accurate representation. The beauty of finance is that all the theories are visible just at your doorstep. I can talk so many hours about demand curve and supply curve, but where is a witness? Where is the proof? But I just take you to the financial markets and say, hey, look, see, I can show you that here is the demand curve and supply curve, and this is the actual. This is the real life functioning of capitalism. If you want to give a proof to somebody that, hey, do you want to see how the capitalism works? Well, I show you, this is how capitalism is working. The same way, the stock prices go up and down. This is the way, for example, if I show you the stock price, for instance, if I go a step backwards and I show you, for instance, some big gainers, the stock gainers. For example, it's a technology company, and you can see that this is how the price has been behaving of this stock. Has been 37.59% jump in the price. Oh my. This is exceptional. Exceptional. So the market waves can go up and down. Sometimes the market is smooth. Sometimes it can be very wavery. It can fluctuate tremendously. I don't remember if I've seen in the recent history with my own eyes that the price jumps by 37.59 percentage points. Oh my. This is scary. All right. So we go back to our lovely slides. And you see that this is the capitalism. This is how the capitalism is expressed. And then we have the demand for the currency, and we have the supply of the currency. Okay, so I want to give you a few minutes. You go through these slides and get some meaning out of it. So there are many factors which can have impact on the exchange rate. You saw that we just saw the Yahoo Finance that the exchange rate of euro in the American dollars was actually sorry, there seems to be some problem. Yeah, so the exchange rate of euro with the American so the exchange rate of euro vis-a-vis American dollar was quite much fluctuating. So what could be the factors behind it? Why do exchange rate not remain stable? Why does it change? The first factor is the relative inflation rate. Inflation, I hope you know the meaning of inflation. What do you think is inflation? First of all, let me clarify this thing. Can somebody explain it by speaking what inflation is? The definition of inflation, if I have to say, inflation is an increase in the price, but not every increase in the price is called inflation. To call inflation, there should be the price increase, but not every price increase is inflation. The price increase is called inflation if it is substantial, huge, not little bit. And the price increase is general. Not one or two commodities become expensive, but in general, everything is more expensive. And thirdly, it stays for a long time. So it doesn't come and go suddenly, you know. So if the price increases and the price of all the goods increases, most of the goods at least, and this price increase is consistently going up for a long time, then this is called inflation. But if price increases and then tomorrow it comes back, and that is not called inflation. So it's very important to remember that there should be the price increase to be substantial, to be for relatively longer period, and the price increase has to be general, basically most of the goods in the economy. Now, coming back to the factors, why inflation is a factor leading to exchange rate going up and down. Now, one thing, those countries where inflation is more, those countries' currencies are lower in the value. Let me give you a comparison. Let me draw a situation, then I think it'll be better that you can see in the. So if I make a new picture, imagine that inflation in the UK is 4% a year per annum, and inflation in the USA is 2% per annum. It means the America has low inflation and the UK has more inflation. So it's almost 4% minus 2% is equal to 2%. So UK is a relatively inflationary economy by 2% in comparison to the US. Other things being equal, pound should be falling in value against the USD, not here, against the US dollar by 2%. Make sense? So the countries which have more inflation, their domestic currency is losing the value. And why it happens? If UK has more inflation, it means people have to pay more prices to buy the goods in London, in Glasgow, in Birmingham, in Manchester. But then they find that, hey, the inflation in the US is less. So they can buy the similar goods in New York cheaper. So what happens then? The import of the American goods increases in the UK. And when you want to buy more American products, more US manufacturers, then you demand more American dollars because you have to pay in American dollars. And when the demand is increasing of anything, its price goes up. It means that when there's a more demand of American dollars in Britain, then the price of the US dollars against the British pound should go up. Same way, when the US has less inflation and the UK has more inflation, then the Americans would find the Britain-made goods expensive. And because the Britain-made goods are expensive, the American would import less from Britain. Therefore, therefore UK would export less to the Britain. UK would export less to the USA. And because UK is selling less goods to the US, therefore the supply of American dollars in Britain would fall. So in Britain, the demand for American dollar is increasing because the American goods are cheaper. And in Britain, the supply of supply of American dollars is going down because the American are buying less goods from Britain. And as a result, what happened? The value of dollar will go up in in UK, and the same way in USA, the value of pound will go down. So it means that those countries where the inflation is going up. So whenever that's very important, that whenever you invest abroad, let's say you buy some shares of some American company, you live in Belgium and you buy some stocks of some American companies, and that stock goes up by 3%. And you are very happy, hey, I should sell my shares now because the price is up by 3%. You sell it. But when you bring this money back to Belgium, you find that you have lost money actually, because the inflation in the US could be higher than in Belgium. So what happens is that when you convert that money back to euros, you get less money. So it's very important that when you are investing abroad, you should be very careful of the exchange rate, especially when, like I was talking to a student of mine yesterday, and he was saying that he has bought some American stocks. The same example. He said that he bought some American stock. They went up, very happy, but when the money comes back to Finland, he has lost a lot of money last year. And it was because the value of the US dollar was very low last year against euro. So this can happen. Okay? So be very particular about these things when you are making the investments. So we go back to the slides, and what we learn is that those economies which are comparatively inflationary, the value goes up of the other currency. I have been using the word appreciation and depreciation too. When the value goes up, for example, this I quickly show you. So in the above example, I can say that based on the above example, it can be said that pound is depreciating. Pound has depreciation against American dollar, and American dollar has appreciation against. So it means that those economy which has more inflation, their domestic currency depreciates, and those economy where the inflation is low, their domestic currencies appreciate. Appreciate means the value goes up, depreciates mean the value goes down. Yeah. Okay, so we carry on. The second factor which can make exchange rate up and down is the relative interest rate. The countries where the interest rate is high, their domestic currency's value goes down, hence depreciates. And those countries where the interest rate is comparatively low, their domestic currency's value is up. The reason is very simple, very simple. In fact, this factor is very much connected to the first point, which is inflation. Remember that the interest rate is a cost. So when the cost goes up, the price goes up, and hence it becomes inflation. And when the interest rate is low, and if you're a business, then the low interest means you have low cost. Low cost means you don't have to raise the price. And when the price is not rising or the price is low, we say that the inflation is low. So that way, the interest rate is also part of your inflationary process. Okay, does it make sense? Because high interest means a possibility of high inflation. Like in the previous example, USA had low inflation. It could be possible that in the US, the interest rate is low. But on the other hand, it is also possible that UK had high interest, and that's why UK has more inflation. So the high inflation and high interest rate are also connected to one another. Then the third factor is the income level. Comparatively, income level. If the increased US income is comparative to UK, for example, if the US GDP is growing 3 or 4% and the UK economy is growing at 1%, then the American would be richer than the British people. And what happened when you become rich? There's a more demand for the imported goods. And as a result, the Americans would start buying goods from the Britain. When they were having less income, they were not able to afford the British-made goods. But now, because they have more income and they are in a position that they are capable of demanding or importing more goods from Britain. On the contrary, it could happen, which is opposite to what I said before, that if the US economy is growing fast, then the US dollar would also become stronger because people want to buy American dollar, because people want to invest in the strong economies. So if you find that the American economy is stronger, they're doing a great job, so then what happened? All these investors, they would like to invest in the American stocks. They want to, they can move their production capacities to the US and so on and so forth. And as a result, the American dollar can become stronger or appreciate. Strong means appreciate, and weak means depreciate. Sorry, after the slide, can you? Sorry, yes, I will go back to the previous example once I'm done with this. So the income is a little bit tricky. Income can make your local currency stronger and weaker as well. If you see the first example, if you see the first example that the American economy is growing stronger than the UK, then the people in US will demand more British goods, and as a result, pound will increase, appreciate against dollar. But on the contrary, if American economy is stronger than the UK economy, then what will happen? Many British companies would like to move to US, or at least they can buy the US stocks, and as a result, the US dollar would appreciate against the pound. And now I quickly share my whiteboard because you wanted it. This was the case, I think. Alisa, is it what you want to see? Okay, good. I'm recording it because when you see the full recording, you can pause and you can see it when you see it on YouTube. Yeah. Okay. So I move on if it is okay. All right, good. The next factor which can have an impact is the expectations. They are very important. In the business, the expectations, the perceptions are very important. How you visualize the future, how you forecast things is very important. If you have an expectation that the pound would depreciate, it normally happened that when there was election recently in the US, there was some kind of uncertain political climate, and during that time, the value of dollar was going down against major currencies. Similarly, I remember when almost 4 years ago, when this Brexit happened, the pound, because that was some kind of uncertain atmosphere, so people were expecting already that the pound's value would depreciate. So expectations play a very important role. For example, I gave this one case of 97, 98, when there was a mismatch between the expectation and the realities in the Southeast Asian countries, and there was a big downfall of the Southeast Asian economy. It was a major banking and the currency failure, because the value of the currency of the major Southeast Asian countries like Malaysian ringgit, Singaporean dollar, Hong Kong dollar, then Indonesian rupee. So the value was going up because they were overly heating economy, and eventually when they fell, the value of their currencies went down hugely. In some cases, I remember that some of the currencies, they lost about 50%, 60% of their value as well, which was huge. So expectations play a very big role when you want to put the value up and down. Similarly, there has been some problem with Russia when they had some debt. Yeah. And there's also deficits. So whenever it happened, that an economy is having a deficit. Deficit means that when the economy's income, the revenue is less than expenses. So for example, there's a country, its all revenue is 100, but its expenses are 120. So in that case, we say that 100 minus 120, 20, yeah, minus. So we can say that the economy is having a deficit of 20 euro or whatever. Now, how do you fill this deficit? It could be possible that you borrow, you print more money, or you do something. Whatever you do, you are creating more money supply in the economy. to cover up this deficit. And when you bring in more money, what happens? More money supply means there's a high chance of more inflation. And when there's more inflation, the value of the domestic currency would depreciate. So in other words, those economies where they have a constant deficit, almost every year, deficit is rising and rising, then those economies are more inflationary. And more inflationary means their local currency's value will go down. You see all the major countries in the world, these major economies, OECD countries, for example, they have very stable and strong currencies. The reason is that most of them have surplus budget, not deficit. The opposite of deficit is surplus. Surplus is that your revenue is 100 and your cost is 80. So you save $20. So that is called surplus. But if it's a deficit, then your revenue is less and your expenses are more, and the deficit is increasing. To bridge, to fill this deficit, you are printing more money, you're borrowing. As I said, whatever happens, printing money or borrowing, there is an increased money supply, and increased money supply means there's more inflation, and more inflation means the value of the domestic currency will go down. This is how it works. Okay. And then we go to the next slide. The public debt. I think it's similar to the inflation. So basically, these are the factors which can push a country's currency appreciated or depreciated. Okay, so we need to keep in mind these things. And I expect from you that next time when we meet, you should have gone through all these points, and we have a small discussion, and and then when we come back next week, when we meet, then we will also study arbitrage more indeed. I gave you the meaning of arbitrage already, that it basically means that when you have a risk-less profit, when you are so smart that you have removed all types of risks and you have definite guaranteed gain in the market. That is called arbitrage, and that we shall study in depth next week. But the homework, if I have to give you for this week, I would say that try to work out all these factors which I discussed today with you. These inflation, debt, deficit, expectations, income level, inflation, interest rate, and find out that did I miss any factor which you think can also be an important factor in determining the rate of exchange. And I would be very happy if you can find some points. So basically this task which I'm giving you, that find out, discuss these factors more in details, and find out some more factors which can have an impact on the exchange rate. That will easily take your 1 and 2 hours at least. And this is the kind of task which we should do. You don't have to give me anything in writing. Don't send me any of your notes. But I want that when we meet next time, we have discussion about it. We discuss, we chat, we talk about it. Okay. So with this, we close our meeting session for the day. And thank you very much for being so patient and actively taking part in the discussion. And once I get the recording with me, I would be sharing it on YouTube, and I send the link to you soonish.
Okay, thank you very much.
So have a beautiful day. Have a great day, and be safe.
Thank you.
Thank you. Have a good weekend.
Thank you very much. You too.
Bye. Thank you.
Bye-bye. Bye.